They will cut rates, they hope, sometime this year, but they have to make sure that inflation is still on its way down. So nothing new in that. The question will obviously revolve around timing, because Republicans want the Fed to hold off until inflation is down because they don't want rate cuts to help Joe Biden. And of course, Democrats want exactly the opposite, cut rates now to help the president and his campaign. So we'll get a lot of questions on that. We may also get questions on the budget deficit. That's an issue for both parties up on the Hill, and the Fed tries to stay out of that, but Jay Powell on 60 Minutes did say that he thought the U.S. was on an unsustainable fiscal path.
Mike, we thank you for your time, your analysis. Stick around. We'll be back with you. Now, Republican presidential candidate is expected to speak shortly in her home state of South Carolina, where she's expected to end her presidential campaign. With us, we have Bloomberg's reporter Anne-Marie Hordern's surveillance host as well. What is expected out of her speech today?
So she's going to be backing out of this campaign. And, you know, we had Matthew Bartlett on yesterday who talked about the fact this was less of a presidential campaign, but a messaging campaign. So the question now becomes, she's going to there's no path for her. This was very likely, and Super Tuesday just confirmed that. She said she would go into Super Tuesday, felt like she needed to do that for her supporters. Oh, and here she is now. Let's take a listen to what the Governor Haley has to say.
Good morning. Just over a year ago, I launched my campaign for president. When I began, I said the campaign was grounded in my love for our country. Just last week, my mother, a first-generation immigrant, got to vote for her daughter for president. Only in America. I am filled with the gratitude for the outpouring of support we've received from all across our great country. But the time has now come to suspend my campaign. I said I wanted Americans to have their voices heard. I have done that. I have no regrets. And although I will no longer be a candidate, I will not stop using my voice for the things I believe in. Our national debt will eventually crush our economy. A smaller federal government is not only necessary for our freedom, it is necessary for our survival. The road to socialism is the road to ruin for America. Our Congress is dysfunctional and only getting worse. It is filled with followers, not leaders. Term limits for Washington politicians are needed now more than ever. Our world is on fire because of America's retreat. Standing by our allies in Ukraine, Israel, and Taiwan is a moral imperative. But it's also more than that. If we retreat further, there will be more war, not less. As important, while we stand strong for the cause of freedom, we must bind together as Americans. We must turn away from the darkness of hatred and division. I will continue to promote all those values, as is the right of every American. I sought the honor of being your president. But in our great country, being a private citizen is privilege enough in itself. And that's a privilege I very much look forward to enjoying. In all likelihood, Donald Trump will be the Republican nominee when our party convention meets in July. I congratulate him and wish him well. I wish anyone well who would be America's president. Our country is too precious to let our differences divide us. I have always been a conservative Republican and always supported the Republican nominee. But on this question, as she did on so many others, Margaret Thatcher provided some good advice when she said, quote, "Never just follow the crowd. Always make up your own mind." It is now up to Donald Trump to earn the votes of those in our party and beyond it who did not support him. And I hope he does that. At its best, politics is about bringing people into your cause, not turning them away. And our conservative cause badly needs more people. This is now his time for choosing. I end my campaign with the same words I began it, from the book of Joshua. I direct them to all Americans, but especially to so many of the women and girls out there who put their faith in our campaign. Be strong and courageous. Do not be afraid. Do not be discouraged, for God will be with you wherever you go. In this campaign, I have seen our country's greatness. From the bottom of my heart, thank you, America. God bless you.
You've been listening to former Republican presidential candidate Nikki Haley. We are still joined by Bloomberg Surveillance's Anne-Marie Hordern. Anne-Marie, she said it is now up to Donald Trump to earn the votes, and I hope he does that. How close is that to an endorsement?
Well, she didn't go outright endorsing him, said she wishes him well, so she stopped short of that moment. She did say she launched this campaign, she's suspending it, she has no regrets. What she's getting out at there are her voters. When you look at a
In his opening remarks, he talks about how the Fed is absolutely determined at this. In his opening remarks, he talks about how the Fed is absolutely determined at this point to bring inflation to its 2% target. So he's not going to cut rates prematurely. Of course, that will be something of a political issue, as we talked about earlier.
Liz, how about the bond market? How are they supposed to expect it? Investors expected to react throughout the 2 days of testimony. We are already seeing it met by a bid in the short-term market here. 2-year yields down a little bit, even just from yesterday.
Yeah, I think, Shonali, his prepared remarks, although you'll
In his opening remarks, he talks about how the Fed is absolutely determined at this point to bring inflation to its 2% target. So he's not going to cut rates prematurely. Of course, that will be something of a political issue, as we talked about earlier.
Liz, how about the bond market? How are they supposed to expect it? Investors expected to react throughout the 2 days of testimony. We are already seeing it met by a bid in the short-term market here. 2-year yields down a little bit, even just from yesterday.
Yeah, I think, Shonali, his prepared remarks, although you'll see a lot of the research report, nothing new, but he kind of seemed hawkish enough. He didn't lean more hawkish than he had to. He focused a little bit on the dual mandate, which some people thought, oh, that shows they're more balanced. But he did say, hey, listen, we're not clear. We have enough.
Feel as if you're free from allergies.
Make up nearly 70% of overall price increases, outpacing modest wage gains. This means that until we address the underlying housing supply shortage, Americans will continue to pay an increasing share of their income on housing. The affordability crisis will worsen and inflation will remain too high. With that said, it's hard to understand why Republicans feign concern about the economy when they're unwilling to address the key driver of inflation, housing. In fact, Republicans have only put forward legislation that makes things worse for millions of Americans, including moving legislation to slash funding for federal housing programs, including in rural America, where homelessness is rising. This abysmal record on housing is par for the course for Republicans. Since they have been in the majority, they have convened only 6 hearings on housing, on top of launching baseless impeachment efforts, censoring members, and pushing our government to the brink of multiple government shutdowns. It's clear that Republicans are too focused on drama and chaos to deliver anything for the American people. That's not how Democrats roll. When I was chair of the committee during the 116th and 117th Congress, not only did we hold 55 hearings on housing, but I and my fellow Democrats enacted 12 critical housing bills into law in the last Congress alone that helped stymie a tsunami of evictions, foreclosures, and homelessness, keeping millions of people stably housed during and after the pandemic. Unlike Republicans, we don't just talk about the issue. Democrats make law. As House Republicans continue to disappoint, committee Democrats are offering evidence-based solutions to keep a fair and affordable housing agenda at the top priority in Congress. That's why I and my Democratic colleagues reintroduce 3 groundbreaking bills to address the housing crisis and bring down inflation once and for all. This includes Housing Crisis Response Act, the Ending Homelessness Act, and the Down Payment Toward Equity Act. Together, these bills would create nearly 1.4 million affordable, accessible, and resilient homes, reduce housing costs in homelessness, and revive the American dream of home ownership for all. So, when my Republican colleagues are ready to get serious about our nation's economy and inflation, Democrats are ready to work with you to pass the bills into law. In fact, tomorrow at noon, I, committee Democrats, and more than 30 housing advocates will join together at a press conference to share just how important ending the affordable housing crisis is to the state of our union. And so I invite all of my Republican colleagues who say they care about this issue to come on and join us. I look forward to discussing this critical issue with Chair Powell today. And, Mr. Chairman, I yield back my time.
The Chair recognizes Mr. Barr, Chairman of the Subcommittee on Financial Institutions and Monetary Policy, for 1 minute.
Welcome, Chairman Powell. Runaway inflation and increased interest rates still have Americans reeling. And while the rate of price increases have come down thanks to monetary tightening, the overall level of prices remain high. The toothpaste is out of the tube, and Americans, the average American family, still is paying about $15,000 more for the same goods and services that they were purchasing just 3 years ago before the Biden administration. So Americans have suffered years of eroding purchasing power in their paychecks. And while I'm pleased the Fed is resolved in getting inflation back under control, I'm not pleased by the numerous recent unjustified, politicized, and underanalyzed regulatory proposals. The Fed needs to withdraw and repropose the irredeemably flawed Basel III Endgame proposal, especially given that 97% of public comments across the ideological spectrum expressed disapproval of the proposal. Chair Powell, I urge you to listen to the American people, withdraw the Basel III Endgame proposal, and tell us today what the Fed's plans are moving forward. I yield.
The Chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair Powell, for being here today. And I had a chance to actually read the monetary policy report from cover to cover thanks to an exceptionally long airport delay, going back home last weekend. And the feeling I got again and again is that things are fairly well recovered from COVID and getting back to normal, that we're in the range where ordinary monetary policy and fiscal policy will allow us to satisfy your dual mandate. Today, unemployment remains near historic lows. Core PCE inflation is down to 2.8% year over year compared to a peak of 5.6% in 2022. And the major stock indices are hovering around record highs. GDP growth continues to beat expectations, and the U.S. economy has added more than 14 million jobs since President Biden took office. The GDP itself is pretty much back on the trajectory that it would have been pre-COVID. U.S. manufacturers alone have added nearly 800,000 jobs, employing more workers now than any point since 2008. And so my lesson from that is that the fiscal response that we engaged in was appropriately tailored, and the soft landing is within sight. So thank you. I yield back.
Gentleman yields back. Today we welcome the testimony of Jerome Powell, Chair of the Federal Reserve's Board of Governors. As you know, you'll be recognized for 5 minutes for a summary of an oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. Chair Powell, we're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As the labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. we at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. And I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve, and we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to, and do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening to these comments that have been nearly unanimous in opposition to this rule? Is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right. We've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out? You would not rule that out at this stage of the game, reproposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that. This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the three components that we look at that make up the core PCE and, index, and it has been coming down from its heights of a couple of years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's been reported that the methodology used to assess housing costs as an indicator of inflation is imperfect, namely because it considers costs based on both new and old rents, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' Housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so, what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill, is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics, and you all discussed the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively. But yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets, in abundance of caution in case there needs to be a resolution, obviously. We know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level, and that seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back, and so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households, and in my view, there's three principal causes. Certainly, we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable, but we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at. But the bigger question really is That change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks, and so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains were disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the, of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet just about. Is that not correct?
I think that's right, yeah.
And I think that you also recognize a mismatch between the strength of the economy, that's what we're talking about, in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high in people. So that's something else that we need to get in control. Is that not correct?
Yes.
And let me just ask this. Can you say that there's a connection, for example, between conflicts in other areas of the world, like Russia's war against Ukraine and or the turmoil in the Middle East and the economic pressures that the United States feels? Does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly the war in Ukraine caused commodity prices to move up sharply.
So could you tell you what is the, what would the connection lead you to believe that there is an urgent need for us, I would think, for, and we're running out of time, for us to do everything that is in our power in Congress to support Ukraine so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction. So I wouldn't have an opinion on Ukraine funding.
But if we had more grain that was going through, wasn't blocked by Russia, things of that nature, that generally just, well, says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia, and we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
I think it's correct that a full supply of grain would help with commodity prices.
And so, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this long-standing work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association